Hello everyone, and thanks for tuning into the Financial Investor channel. My name is Brent, and today we're going to be taking a look at stocks with ex-dividends next week. Now, we're going to be using YCharts and Dividend.com to screen for and look for some stocks that are going to be, that could be undervalued next week and that could be good potential buys. We're going to be searching for all the stocks that are coming up with ex-dividends next week. We're going to be adding all the stocks that have a rating of 3.4 or higher, and we're going to be using the DARS rating, which it measures their dividend paying, the dividend payment, the dividend yield, the strength of the stock overall. The next 4 quarters, is it going to be profitable, the payout ratio, and a few other items. So we're just going to capture the strongest of the stocks that are coming up next week with a rating of 3.4 or higher, and then we're going to be adding them over to YCharts. Now, I do have a video on how to access YCharts for free. It's a free tool that I have, and you guys can check out that video in the top right corner. It just says access YCharts for free, and then check out that video. So over on Dividend.com, that's what we're going to be starting up with first. So we're just going to be capturing some stocks that have ex-dividends next week, and then we're going to be screening them. So let's go over here, and all we're going to be doing is selecting our ex-dividend dates here, and then I'm going to go ahead and uncheck all these little check boxes here. All I'm looking for is for some common shares, and next week is March 12th through March 16th. Man, we are flying through time right now. Can you believe it? So we have our dates. Let's go ahead and hit search. And there we are. Now we have a bunch of stocks listed here, and they're all out of order. So I'm going to go ahead and sort them by strength. Now we have 3.9, Motorola moving on up there in the rating system. So all we're going to do is take, you can see there's quite a bit of stocks here with a rating of 3.4 or higher. Now, some of these that didn't make the list that have actually done pretty well lately is Hewlett Packard. I've seen that one in the news lately. Jumping up 10% because they did actually do well on their earnings. And that is Diane Equity. I was actually invested in that one back in early July. They dipped and I had sold it off. But let's see here. Yeah, H&R Block there. So there's a couple names here. Domino's down here at the bottom, 3.2 there. So you can see here that there's several pages, but I'm only focused on adding the stocks here with a 3.4 or higher. Now, let's go ahead and begin entering them over here on YCharts. So over on YCharts, all we have to do is enter the ticker symbols, and that's it. So I'm going to go ahead and pause the video, not to make this video too long. I'm going to go ahead and pause it and add all these ticker symbols into YCharts all the way down to the last 3.4. So I'll be right back. Okay, and we are back. So we entered roughly 40 stocks into YCharts. You can hear, let's go ahead and blow up YCharts here now because that's all we need, Dividend.com for now. And I'm going to go ahead and zoom it, and you can see that there's tons of stocks in here. Now, if you use the link, if you follow my other video and use the link, you're going to be able to have all of the financial metrics that I used already inputted just by clicking the link. So next, what we're going to be doing here is we're going to be first removing stocks that have a PE ratio greater than 25. So that's going to be our first elimination. Now, why do I do these stocks with ex-dividends next week? Well, there's a lot of stocks out there. There's more than 5,000 publicly traded stocks. And doing this helps me just kind of recognize other stocks that are out there that I may never have heard of that could currently be undervalued at this time. So by doing this, it kind of opens me up a little bit and opens you guys out there that are viewing these videos to brand new stocks you may never have heard of. Have you ever heard of the Renaissanceker Holdings or J&J Snack Foods or Validus Holdings? Most of 90% of the time you're not going to recognize a lot of these stocks in here. Hillenbrand, Global Payments, Fidelity is there. That's one that I know of, a name that I recognize. Now let's go ahead and select PE ratio, and it's only going to let you screen about 10 stocks at a time. So you're going to have your 10 stocks here. We're going to set it to 1 year. And all we're looking for is anything here that has a PE higher than 25. You can even go lower if you'd like. So in this example, I'm going to remove Texas Roadhouse. So Texas Roadhouse, you are out, I'm sorry. And then we have the purple line right here, which looks like a Amarin. So I'm going to go ahead and uncheck it just to see if that removed it. Yes, that's it. And then uncheck it or just hit the X and there we are. We have several stocks here with ratings under 25. Now I like to go backwards. I like to check the next one and then uncheck all the previous ones, and then I'll kind of check the next 10 here and then let that load up. So we have Merck & Co. 62. That's a pretty high rating. We'll go ahead and remove that. We're trying to keep ourselves semi-safe, so if there's another correction that takes place, it's very unlikely that a lot of profitable stocks will fall below a negative PE because they're all going to be profitable. So the price in comparison to the earnings are actually going to be very, very low. So I don't believe it's ever been a 1-for-1. There may be a few stocks out there that have a very low PE ratio, but it's very rare. So let's see here. What is next? This purple one is Broadridge, it looks like. So let's uncheck it. That's correct. I'm going to go ahead and remove it. Then we have the First Final Bank, Shores, and we have J&J Snacks, and that leaves us with a bunch of stocks under 25. And again, just go ahead and check the next one or remove the prior one. So we have Coca-Cola in here with earnings or ex-dividend next week, so that's a good one to look out for. We're going to screen to see where these ones are currently sitting at. So we have Albemarle. So we're going to go ahead and remove that. So instead of making this video again really long, all I'm going to do is continue going down this list, making sure I remove stocks that have a yield or a PE over 25. So Coca-Cola here could actually be a little bit off. So what I'll do is I'll go to my Morningstar and I'll enter the ticker symbol for Coca-Cola. And you know what I just did? Okay, so it's a very high PE. So what I did is, okay, it kept it. Excellent. It kept my website. So that's good. I thought it had removed it. So that's actually correct. I'm not sure why Coca-Cola is showing such a high PE, but I'm just going to go ahead and not mess with it right now and just kind of continue on. So I will be right back, pausing the video. Okay, welcome back. So now we have all of our stocks out of here that have PEs greater than 25. So that's about what the average is for the S&P 500. So the next step is, now that we have our list down, then sort of down, now you can see all these stocks on a single page. The next thing I'm going to be doing is looking for a dividend yield over 2%. So we've had a correction recently, so I'm looking for stocks out there that may have fallen a little bit below their 1-year average. So all I'm going to do here is select a few here and look for their yield here. So okay, oops, I have PE still checked. Make sure you uncheck and then just select dividend yield, only that one. So all we're going to be doing here is, again, anything with a PE or a dividend yield under 2%, we're just going to go ahead and remove it. Now you can lower your yield, but a lot of dividend investors that like to invest for the long term, they like to buy dividend yields between 2 to 6% is a pretty good range. That way, for every $100 you're investing, you get roughly $2 to $6. So if you invest a $10,000 at a 2% yield, you're making $200 back. If you get a 6% yield, you're making $600 back off that that $10,000 investment. Plus, you get capital appreciation. So those dividends, they compound depending on how often you're paid out dividends, and if you reapply those dividends that are paid out. So if you have $600 coming to you, 6% from $10,000, and you reinvest those $150 every single quarter, then by the end of the year you won't be making $600. You would have made roughly $615, $610, because it compounds month after month. So Continuing on here, I'm going to go ahead and remove some of these stocks here with a yield over 2. So Chesapeake, this is one that you get from Robinhood for free. So if you guys haven't checked out Robinhood or M1 Finance, I do have video playlists for each one of those. So if you guys are interested in checking those out, you guys can check out the link in the top right corner. I'll go ahead and place one. I think M1 Finance is one of the better ones, so that's one I would definitely suggest checking out. So there we are. We have all those with a dividend yield over 2. And here we're removing the wacky Renaissance one, and that's pretty good. Now anything with a yield over 6 could be considered risky. It's really up to your risk level. A lot of times any stocks that have a yield over 6%, the reason they have a yield over 6% is because they recently went through a correction in the stock. So the price divided by the payout ratio, or not the payout ratio, the dividend payout that they pay out gives you the yield. And if the price fell down very sharply and then you're dividing the price into the yield, you're going to get a very high percentage because the price has gone down by so much. So WR Berkeley, remove that one. Where are you? At the top, almost. And we have a couple here, Simmons and Worthington. So again, we're just about done. Otherwise I would have paused the video and just removed these other ones here. Motorola, boy, almost had made our list, but so now we're down to roughly, looks like maybe somewhere around 20 stocks. So next thing I like to look for is increasing revenue, net income, and free cash flow over the last 10 years. You know, we've been on a very nice up incline. So I like to select revenue, free cash flow, net income, and hit the percentage. Now how much, you could also include price in here if you'd like. You can see how much the price has gone up over the last 10 years. So UGI, the stock itself, price has gone up 151%. Its net income is increased by 102%. Its free cash flow is up 57%. You can see that it was very positive at one point. They may have done an acquisition here back in 2016. And then their revenue has been pretty consistent, still in the positive, but their net income is increasing. So that's really nice that their revenue has been pretty normal, but their net income is increasing. So I'm going to go ahead and keep that one on the list. Now, some of the ones I'm going to be removing are ones that have negative net income or negative revenue, or one or the other. So Altria Group here is up 184%. Their net income is up, but their actual revenue is down, and so is their free cash flow. So this is one that's pretty, you know, it's actually surprising to see that their revenue is pretty flat over the last 8 years, but their net income is up. So something happened in 2016 that really drove their net income up, and then it came down recently. But I'm gonna go ahead and leave it for now. I don't like to see that their revenue is on the decline, but yeah, let's go ahead and remove it. Actually, I'll go ahead and remove it. We have GILD Science. This is one that's a monthly dividend paying stock. If we add their dividend here, you can see that they've no, this is one. Okay, so I believe they're a monthly paying stock. I think this one comes up quite a bit on some of the dividend Facebook groups that I'm in. So this one is up huge over the last 10 years. It was pretty mild until roughly 2013, and then all of a sudden 2014 this stock shot up in revenue, it shot up in free cash flow, it shot up in net income, and its price has actually been pretty it's actually on a downwards trend ever since it sort of peaked here in 2015. It looks like it peaked and then has came down, kind of bottomed out right around here back in 2017, and then has been on its way up. So pretty interesting stock there. I will go ahead and leave that one in there for now. We have Garmin. This is negative basically almost across the board besides the price. So the price is pretty stale, you know, only 6% over the last 10 years. It's actually down in revenue, it's down in free cash flow, and down in net income. So removing that one. And then that's all we're going to be doing here for the next few. So if it has negative revenue, negative net income, then I'm going to go ahead and just remove it right away. It's not worth trying to, mess with it. So this one I'll leave it. Owens, go ahead and remove it. Mercury General, this one is negative net income. So whereas it's a revenue, it's going up. No, that's just free cash flow. Free cash flow has been going up. Its actual revenue is, it's positive, but its net income is going down. So it's not making much money there. So I'm going to go ahead and remove that one. Validus Holdings, we have all sorts of negative here, and free cash flow and net income. Negative in their free cash flow. That's fine. You can see this was a huge sharp drop between 2016 and now. So this could be an acquisition that took place. They acquired something. So definitely want to take a few, read through the 10Ks. But they actually have very nice net income. They have good free cash flow and revenue. Oh no, their free cash flow is down, but only 91% down, and they can actually make this back up. You can see it kind of bottomed out here. So they probably did some sort of acquisition, and now they're beginning to get some free cash flow back from it. I'm going to go ahead and leave that in there. Revenue down, free cash flow down. Their price is up and their net income is up. Now this is one that you guys can kind of decide, on your own, but I don't want to have the list too large there. Free cash flow, that's fine. All positive, that's good. Packaging, all positive, that's good. We have some negative revenue and some negative free cash flow. I'm going to go ahead and remove that. We have some better ones already out there. Now this price has gone up 44% over the last 2 years. This is a 2-year graph. You can see here it started here 16, 17, 18. So right here it probably started right actually in 2016, because this is the midpoint of July. So here it would have started in 2016. So this is showing us a 2-year data. So I don't like to invest in companies that haven't had, they haven't been out there publicly for more than 10 years. There's just not a lot of information to kind of base it off of. This one, Fidelity, up very nice in just price and net income and revenue, and look at their free cash flow. It is swimming up here, up huge. So that's very nice to see. All positive, that's great. So here you can see that there's many stocks out here that actually have all 4 things positive. One of the things I wouldn't mind seeing is their price being negative and then their net income and their revenue being positive. That just means it's a good buy. So here we have revenue and free cash flow down in the negative, so I'm going to go ahead and remove that. DTE, free cash flow is down in the negative, but everything else is pretty consistent. These very, again, large spikes, these could be acquisitions. We're going to go ahead and keep it in there for now. Net income down, we're going to remove it. So I'm going to go ahead and remove anything with a negative, because I want to have at least just 5 stocks or under. So we actually have a lot of stocks that are actually all 4 in the green, and we don't need to find stocks here that have any negative, because a lot of times if you're investing for dividends, you want that free cash flow out there, because it's a reserve. If they have to, they'll pay you dividends from their reserve. Their free cash flow is just up high. So here we are. We have UGI, GILD, CTBI, CBU, PCG, FNF, and Meow, Mantax. So now let's take a look at their book value, I suppose, but we could actually just break out into dividend.com now and just take a look at just these specific stocks. So we have UGI, we have GILD, we have CBU. Where is CBU? Right there. PKG, FNF, Fidelity. See, I would have never even checked out some of these stocks like Mintax, never heard of it. So now we're going to look at these. Which one of these stocks has been paying out dividends for more than 10 years? Right off the bat, UGI, which was rated at a 3.9 by the graph, This is our strong winner right now. You can see that it was rated very highly because it has very consistent dividend increases, 32 years. Its payout ratio is very low, only 38%, meaning that if their earnings for some reason during a recession got cut in half, their payout ratio would still be under 70%, which is amazing. And diversified utilities, they're currently on a downwards trend just right now because over they're increasing interest, which a company that may have some debt on the balance sheets, they have to pay off that debt, and it's with rising interest rates, it gets a little bit more expensive. But for the long term, if you're a dividend investor for the long term, 32 years of increasing dividends, good looking stock. We'll have Khalid Sciences here. This is one that's only paying out dividends for 2 years. We have Community Bank paying out dividends for 7 years. Packaging Corp of America for 7 years. Fidelity for 6 years. And we have Mantex for 7. So let's take a look here and organize these by. There we are. So number one, we have UGI. Why is it number one? Dividends over 10 years, meaning it's recession proof. It survived the 2008 recession, the 2000 recession, the 92 recession. It's continued to pay out through multiple recessions. They pay out $1 per share. So you can actually spend your first $100 invested into this company. You can pick up 2 shares. Yes, you'll only make back $2 in dividends, but you may end up getting some capital appreciation in there, and then year over year they'll be increasing their dividend. They've done several stock splits, so for every 3 that you have, they'll give you 2, or for every 2 that you have, they'll give you 1. Oh, so they'll give you 3 for every 2. And then they also increase their dividend. So when they do a stock split 2 for 1, they'll give you 2 of their stocks for every 1 that you have, basically doubling your dividend payout. So if you have 100 shares of them and you're getting paid out $50 a year, now they double that. Now you have 100 shares and you're making, or you have 200 shares and now you're making, instead of $50, now you're making $100 just in dividends. And you can see here it's happened again. They did another split here, 3 for 2. So for every 2 that you have, they give you 3. So now if you have 200 shares, now you have 250 shares instead of 150 dividend payout. Now you're making half of 150, 75. So you're making $225 in dividends. So that's the way little stock splits work. So good long-term dividend there. They pay out 25 cents every single each quarter per share over the course of the year. 4 quarters is $1. Number 2 is Mantex. It's a specialty chemicals, rated number 2 because it has 7 years of dividends. For the 7-year category, there's 3 of them, but this has the lowest payout ratio, and it has nearly the highest yield. Now, we should also talk about their ex-dividend dates. That's something I haven't been discussing in my videos. So here, ex-dividend is March 14th, which is Wednesday. So you do need to buy this stock on Tuesday or prior. Another March 15th, this is Thursday, so you need to buy it on Wednesday or prior. March 14th, again, another Thursday. This is for PKG. You have to buy it Wednesday or prior to be eligible for that dividend payout, which is then on the April 13th. Number 4 is CBU Bank, Northeast Banks. They have a pretty nice dividend yield. It's in the financial sector, so they've actually done very well recently with increase in interest rates and such, so becoming more profitable. Their dividend date is their ex-dividend is on March 14th, which is Wednesday, so you need to buy it and hold them on Tuesday to be eligible for the payout on the April 10th. Fidelity here, surety and title insurance, 6 years of dividend growth, number 5 here with a payout ratio of 44.6. Very nice dividend yield, over 3%. Their ex-dividend date is March 15th. And then we have Khalid Sciences Biotechnology. They've only been paying out dividends for 2 years, dividend growth for 2 years, but that is because they just started paying out dividends back in 2015. So they only have 2 years of dividend records. That is why their dividend growth only shows 2 years, because they've only been paying out dividends for 2 years. So that's that. But as you notice down here towards the bottom, oh, they are quarterly paying one. Okay, so you can see here that they increased their dividend from 47 cents to 52 cents to 57 cents. So they're increasing their dividend very nicely. That difference there between 52 and 57. So if we do 0.57 minus their previous 0.52 and we divide it, 0.57 minus 0.52 divided by 0.52, which is the original, no, the original is 0.57, and we multiply that by 100, that's an increase of roughly 8.7% increase in dividend. So over the next 10 years, your initial investment will basically double because of the Rule 72. Now, of these ones, which one of these currently looks undervalued? So one thing I like to take a look at is the dividend yield over the price. So recently, UGI, because it is a utility company with rising interest rates, this stock did come down from roughly $50, almost near $50, down into the $43 area. Now this stock has hit several times. It's hit that 42.50, and it's sort of rebounding. That's kind of like its support level. Whereas its yield, it's really never had a yield in the 2.27 range since back in 2016. Back here in this little time frame right here, this is just, you could have bought this with a high yield in the near 3.75s. That's probably because the price is coming down and the payout that they had there was high. Yeah, so good looking stock here. Yield over the price right now. GILD Sciences, yield over price, so good looking stocks right there. Price over yield for Community Trust. Price over yield for Community Bank. Packaging Corp, price over yield. Fidelity is price over yield, and Mantax is price over yield. So right now, the two looking discount ones that could be good pies for the long term are UGI and GILD Sciences. So that is basically it for this video. I do want to thank everyone for kind of hanging around watching the video. If you are going to be checking out any of these stocks that we covered today, go ahead and let me know in the comments below. Again, the ticker symbols were UGI for UGI Corp, MEOH for Mantax, PKG for Packaging Corp of America, CBU for Community Bank Corp, Bank, FNF for Fidelity National Financial, and number 6 is GILD for GILD Sciences. So that is it for this video. If you guys have any questions or want to say hello, please leave them in the comments below. If you're brand new to my channel, hit the subscribe button, hit the thumbs up button to like the video if you did enjoy the content. As a friendly disclaimer, I am not a financial advisor or tax professional. The information provided is my opinion for entertainment and fun. This is not investment advice. This is just me as a financial investor trying to help others make their money work for them. So we took a list of around 50 stocks, screened it for PEs less than 25, yields over 2, increasing net income, increasing revenue, increasing free cash flow. Those are all great metrics, and we have 2 stocks out there that are currently trading with a yield over price. So that's some good research right there that we did in under 30 minutes. We cleared out a list of 40. We have some potential buys. Now we just have to go do some more research, take a look at the 10Ks. Are these really great buys? That's for you guys to decide. So thank you guys for tuning in. I will see you next time. Have a great day. Bye.